This is level 1 of the CFA program, the topic on financial statement analysis and the reading on inventories. I want to tell a quick story about my father, and I'm going to use this example throughout this slide deck. My dad was a moderate beer drinker, but he loved Budweiser, and he used to take me to the distributors, and he would buy a case of Budweiser. And when he would select the particular case, he would open it up and he would feel the bottles and he would look at the case, and it had to be the perfect case for him. And sometimes he would switch. And when I was younger, it didn't really dawn on me that this had any financial applications. But when I got to college and learned about inventories, it finally dawned on me that with my dad picking a particular case of Budweiser, that was going to impact the profitability for Anheuser-Busch. For example, what goes into the manufacture of beer? You have water and barley and hops and yeast. And so I thought to myself, what if the price of those inputs dramatically increased during the production process? And my father would pick up this one case of beer that might have cost, $5 to manufacture versus one that had been manufactured, let's say a month earlier. Maybe that only cost $2 or $3, or maybe it cost $8. So my dad's selection of that particular case of beer had financial ratio implications as well as profitability implications. Of course, this is the kind of stuff that I thought about when I sat in my undergraduate classes back in the old days. But you'll see exactly what I mean as we go through these LOSs. So look at that second one here. Describe the different inventory valuation methods. That is by far the most important LOS in this reading. And once we learn those different valuation methods, we'll be able to talk about things like inflation and deflation. We'll be able to talk about what goes on the income statement, what goes on the balance sheet, and then a LIFO reserve and LIFO liquidations. And then, much like we've been doing in these series of readings, we'll have to go ahead and look at financial statements in general and financial ratios. So let's get started with that first one and take a look at the difference between what the International Standards Board and the U.S. Standards Board thinks about inventories. So look at those first points there. Inventory cost should include all the costs of the purchase, costs of conversion, and then the other costs of bringing inventories to their present location. And so look down at the very bottom, transportation and handling costs, of course, the purchase price, and then any government-related layers on top of those costs. But go ahead and look down at the bottom exclamation point. Of course, those costs of purchase have to be reduced by any kind of a rebate, any kind of a trade discount, or anything else that might impact that cost. Let me go ahead and remind you, what we're doing as good financial analysts here is to assign a value to a company. And to do that, we have to assign a value to their long-term assets, which of course we'll do in a future reading. We'll call that capital budgeting. But here we're assigning a value to current assets or short-term assets, and in particular, the inventory section. So you think of a company like Anheuser-Busch with their massive beer production, so they have cases of beer, of all different kinds of beer. Or think of a company like Under Armour or Nike, who makes hats and shirts and all different sorts of stuff that we wear on the golf course or for physical activity. I mean, these inventory costs can be huge. And so if we select a specific inventory valuation method, that's probably going to impact everything in those financial statements. Now, of course, we need a slide about what kind of costs are excluded from inventory. And so you remember when we did the income statement reading, we had revenues, then we minus the cost of goods sold, which we're going to talk about at length here today, and then we had minus selling and general and administrative expenses. So there you go, look at that third one there. All administrative overhead and selling costs are excluded, but you knew that from a previous reading. Storage costs, you're not allowed to put those in under both the U.S. and the international standards, but notice what we have in parentheses, unless, of course, it's required as part of the production process. And then going back to my dad's beer example, let's suppose that we have the yeast and the barley, and we put it over in the corner, and some worms or ants get into it, and we have to throw it away. Well, you can't include those. So those are called abnormal costs. Now, notice what happens in those three areas, that those things are going to be treated as expenses, and we throw them over to the income statement. We can't include them in the cost of inventory. So once again, what did I say in my initial example? That we have to distinguish between what goes on the income statement and what goes on the balance sheet. All right, valuation methods. I learned back in my undergraduate days, it's better to remember the exclusion than to remember every other intimate detail. So notice that both the international and the U.S. standards groups, they allow specific ID, weighted average, and first in, but only in U.S. are we allowed to use last in, first out. And we'll spend a good amount of this slide deck distinguishing between first in and first out and last in and first out. So let's start with probably the easiest among the inventory valuation methods, specific identification. Just skip to the very bottom. These are applicable for purchase and sale of expensive or unique items. And I'm guessing that those of you who watch my videos regularly will know that I refer to the Pink Panther diamond in multiple examples, not least of which is the capital budgeting example. I'm guessing that many of you are not old enough to have watched the old Peter Sellers Pink Panther movies, but hopefully you've watched the Steve Martin Pink Panther movies. I mean, pure fun and games and silliness. But of course, there's only one Pink Panther diamond. But suppose there were 5 or 10 different kinds of Pink Panther diamonds. Each were cut to specific characteristics. I mean, I don't know anything about science, so I don't know what goes into the cutting of a diamond, but you can just envision, different cuts here and there, different grades. And so you would probably want to identify the cost of that particular unit. So look at the top just quickly. They're not interchangeable, right? My father's cases of beer. Now, maybe not to him they were not interchangeable, but clearly they all look the same. Now, weighted average cost, this on the surface looks like a super easy calculation. There's the formula, right? Total cost of goods available for sale divided by total units available for sale. So what this does is this gives us a sense of what those input prices are over time, and then we kind of take an average. So what I want to do now is I want to give you an example going back to my dad's cases of beer. Suppose that when my dad shows up at the distributor, and let's forget about retail and wholesale costs here. Let's just suppose there are 10 cases of beer, and that there's a cost of, let's say, $25 per case of beer. However, that prices of barley and yeast and hops, they have been increasing dramatically. So I want you to think about 10 cases of beer lined up in a row. The first case cost $1. The second case cost $2, and 3 and 4 and 5, all the way up to 10 as an inventory cost. All right, so clearly if my dad picks the end unit that costs $10, then Anheuser-Busch's profitability is going to be, what is that, 25 minus 10. But if he picks up the first case of beer, and that's $1, then their profitability is going to be 25 minus 1, which is $24 in profitability. So you see which case of beer that my dad picks is going to determine Anheuser-Busch's profitability. Of course, if we use the weighted average cost method, then we're just going to pick an average cost of all of those units, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And so what we could do is we could get out our calculator and we could add 1 plus 2 plus 3 plus 4 plus 5 all the way out to 10, and we'd get 55. And then we divide by the 10. So there's our weighted average cost of $5.50. Or you can be clever. Remember that earlier reading that we went through when we talked about counting and summation. So really all we have to do is take the 10, right? 10 units times n plus 1, which would be 11. So 10 times 11 is 110, and then divide that by 2. N times n minus 1 divided by 2. That gets me my same $55 in costs, and then we divide that by 10, so there's our $5.50. So you see what's going on here, that of course with the weighted average cost, we're going to try to find the middle, right? Find the mean or the median or whatever that thing is in the middle, and we're going to use that to reflect the change in input prices over time. Now, here's what I was saying earlier about my dad and his case of beer. So the first in, first out. So the first one in was that one that cost us $1. That means that that's going to be the first one sold. So if my dad picks up that first case, he's automatically assuming that we're using first in, first out. If he picks up the last case over on the far right, that's the last one in, that's the first one out. So of course, the choice of these two methods is going to impact the financial statement. So look at that middle row. Under FIFO, the cost of sales reflects the cost of goods in the beginning inventory, right? So that was my $1 for my dad's case of beer. Look over on the right-hand column, the cost of sales under LIFO reflects the cost of goods purchased more recently. All right, that should make perfect sense. All right, so what does this mean in terms of rising prices and falling prices? So I'm going to go ahead and read these. In fact, I think you ought to get out your camera and take a picture of this one here. But if you think of my dad and his selection of one out of those 10 cases of beer, I think you'll be able to answer a question about rising or declining prices. So let's do FIFO. In periods of rising prices, the costs assigned to units of ending inventory are higher than the costs assigned to units sold. And for LIFO, it is just the opposite. And then in periods of declining prices, you guys know I love to do this, we're just going to turn it on its head. Under FIFO, the costs assigned to units in ending inventory are lower than the costs assigned to the units sold. So let's go ahead and take a deep breath and let's go and look at an example. And it'll take us a while to get through this example. So here we have a table of activities during March, units acquired and units sold. And look at the very top there. What we're going to do is to consider LIFO and the weighted average cost inventory methods. And we're going to compute, among other things, the costs assigned to ending inventory. So let's go through this middle column first. What are we doing? We start with 90 units at $50.80, and then we make a purchase. So we've got 90 plus the 220 in our inventory, and then a few days later on March 9th, we sell a bunch of these things at $85.80. Now notice 90 plus 220, we had 310 in inventory. We sold 250, so we're only left with 60 units of inventory. So we probably need to replenish that inventory, which we do on March 18th and March 25th. But notice that we don't purchase either the same amount of units or at the same price. So we buy another 120 units at two different prices, and then we sell 120 of those at $95.80. All right, so think about this. We have our inputs have increased from $50.80 all the way up to $62.80. So this is a period of rising input prices. But then, of course, notice on that far right column, we are able to sell our units of inventory at rising prices from 85 to 95 during the month of March. So the question then becomes, what happens to our inventory value during that course of the month and then at the end of the month? So let's go ahead and start with LIFO. So once again, let's take another deep breath. All right, so sales, this is going to be identical no matter what method we use. We'll take that 250 units that we sold, and I'll toggle back here, on March 9th. And then we'll add the 120 units that we sold on March 29th. And of course, those are at different prices. And so we sum those and we get 32,946 worth of total sales. Notice on the left-hand column, that was 370 units. So the next question is, let's go ahead and decide what kind of a value can we assign to those 370 units that we just sold. Now, one distinction that I didn't make in my father's selection of the first case or the last case of Budweiser was the following. There are two different and unique ways to value inventory, regardless of what method that we pick, in terms of handling the timing issue. Now, remember back in time value of money, we originally discussed discrete compounding, and then we added continuous compounding. Well, the inventory valuation methods do something very, very similar. The perpetual method is like continuous compounding. We need to be aware of, let me go ahead back to our previous slide. Notice that we had some beginning, then we did a purchase, then we sold, then we did a purchase, then we did a purchase, then we sold. So under the perpetual method, we're going to be sensitive to those sales and purchases. Under the periodic method, what we're going to do is we're going to skip to the end, and then we're going to look back and say, oh, what did we do over that time period? All right, so let's work through both perpetual and periodic. So what we're trying to do is determine the cost of sales. So let's go back. Perpetual or continuously, what was our first sale? 250 units at the 85.80. Well, we probably sold, well, let me go back here, under this last in, first out. That must mean that we sold those entire 220 units that cost us $55.80. Let me go back real quickly. So of the 250 sold, we sold 220 at 55.80, which means we had to dip back into our beginning inventory. So we had to have sold 30 of those 90 units at $50.80. So there's the 250 minus the 220. That gives me those 30 of beginning inventory at the $50.80. So let's go ahead and do the same thing for our March 29th sale. We sold 120 at 95.80, swinging back to the LIFO method. Well, we had 140 units that we purchased on March 25th, which must mean that we sold 120 out of those 140. That should make perfect sense. So that's what we're doing out there. We're selling 120 at the, here, let me just go back quickly, 120 out of those 140 at the 62.80. So if you get out your calculator and you do the multiplication and the summation, you get 21,336 of cost of goods, cost of sales under the perpetual method. Under the periodic method, remember, all we're going to do is we're going to go way to the end and then look back. So what did we sell? We sold 370. So how did we sell those 370? Well, whoops, I went the wrong way. Sorry about that. How did we sell those 370? Well, we sold the 140 that we bought at 62.80, right? Then we sold the 80 that we bought at $60.80. Let me go back there. So we sold the March 25th purchases. We sold the March 18th purchases. So to get up to our total of 370, we have to go back to our March 5th purchases. So let's go ahead and do that. So that's where we have the 370 total minus those 220. So that's 150. At that $55.80. So see what we did under the periodic. We kind of skip to the head, skip to the end, and then we look backwards. And so that gives us a total of $22,026. Notice the difference under the perpetual and the periodic method, and the difference is just minor here in this case, but that doesn't mean it will have to be minor in that case, because imagine if we were doing this for my dad's cases of beer and it was 1 and 2 and 3 all the way up to 10, but then my dad decided to buy 2 or 3 cases of beer one time, and so we have to replenish, and so perpetual and periodic will make some potentially substantial differences in that final cost of sales calculation. All right, gross profit, this is going to be super easy. So all we're going to do is take our sales, which we computed at the top, and then subtract out both the periodic and the perpetual cost of sales. So we get 11,610 and 10,920. Now, our ending inventory calculation is probably going to require us to take another deep breath. So under the perpetual method, what we need to do is go back and figure out which of those things were kind of left over, right? That's what we're thinking about under the continuous method of doing this. So we know that we were left with 60 units of our beginning inventory, right? So there's the 90 minus the 30. That gets us times the $50.80, right? That gets us the first part. Plus, well, what did we do? Oops, I went the wrong way again. What did we do? We know that on March 18th and on March 25th, we bought 80 and we bought 140. And on March 29th, we sold that 120. So we need to assign a value to there it is, the 140 minus the 120, the 20 units that we bought at 62.80, plus that entire amount. Let me go back one more time, plus that entire amount of the purchase on March 18th of 80 units. So there we have it. So if you sum those, you get $9,168 for ending inventory under the perpetual method. Now remember, under the periodic method, we're going to skip to the end and then look backwards. And so if we're doing this LIFO, last in, first out, that must mean that my dad's first case of beer is still in there, right? So let's go back. All 90 units at $50.80 must be in ending inventory. So that's the second calculation there. Notice the 90 units times the $50.80. And then we must have gotten the rest of them at that $55.80. And so that gets us to 70 units times the 55.80. So what was that? 70 plus 90. That gets us our ending inventory. Look over on the left of 160 units. So that's $8,478 worth of ending inventory. And so note that in order to fulfill this LOS, calculate and compare cost of sales, gross profit, and ending inventory, what you need to do is you need to start at the top for sales and work your way all the way down to the bottom for ending inventory. Now let's go ahead and work through the math here under the weighted average cost. Of course, the sales, what did I say earlier, is going to be the same, $32,946. But we need to figure out that weighted average cost per unit. Now in my dad's 10 cases of beer, it was super easy to calculate that $5.50 because we didn't have any purchases in there and we didn't have any sales in between. So let's go ahead and look at the perpetual weighted average cost per unit. So before that March 9th sale, we have the 220 units at the $55.80 plus the 90 units. Here, I'll go back. There's those two, the beginning inventory and the March 5th purchase. And so if we do that and divide by the 310, right, the 220 plus the 90, we get $54.35 per unit. And then we need to go to the March 29th sale, and we're going to say, okay, we got 60 units that are left over that we didn't sell at that $54.35 plus the 80. Here, let me go back. Plus the 80 at $60.80 plus the 140 at the $62.80. And if we divide by that total of 280 units, we get $60.42. So once again, the weighted average is going to be reflective of the simple fact that input prices are rising. Now, under the periodic method, we're going to go ahead and just sum all of those, 90 at the 50-80, 220 at the 55-80, 80 at the 60-80, and 140 at the 62-80. And so here, let me just go back quickly. All we're going to do is take that middle column, right, and do the math, do the multiplication, and then sum those divided by the 530. That gets us $57.55. So notice that in this case, because we had two sales, we have two weighted average costs per units under the perpetual method, but under the periodic method, we don't really care how many sales that we have. We assign an average value to all 10, as it were, all 10 of my dad's cases of beer. Now then, to get cost of sales, what we need to do is multiply the 5435 times the 250, right, the 220 plus the 30, and then the 6042 times the 120. And so if you sum those, what is that, 13,000 and 20,000, or I'm sorry, 13 and 7,000, you get about, what is that, almost 21,000. And then under the periodic, you get a little bit more than 21,000. And on this next slide, I go ahead and sum those for you. So the gross profit will take the 32,000 minus the roughly 21,000. So that gets us 12,108. And under the periodic method, we get 11,652. And then this is where the ease of the weighted average cost really comes into play. So ending inventory for perpetual, because we have those 160 units all at that $60.42, we just do the multiplication, and then we do something similar to in the periodic, and we get 9208. Now, this slide and this slide here, this is pretty much a summary of what I just explained. So what I want to do is I want to go back here and remind you to get your cameras out. I told you to take a picture earlier, so I want you to take a picture of this one, click, and then go ahead and take a picture of this one, carry this around on your phone. And this is a great summary slide together with this one that will tell you the impact of, boy, what's that LOS ask us? Inflation and deflation, and how it impacts cost of sales, profitability, and then closing inventory. Couple of additional concluding remarks here. Ending inventory amount under FIFO will more closely reflect current replacement values. Of course, the ending inventory in my dad's example of that $10 case at the end of the line, that will, let me repeat that, will more closely reflect current replacement values. The LIFO ending inventory amounts, however, are typically not reflective of current replacement values. And so there's a really, really good question embedded in here about replacement values under LIFO and FIFO, whether those input prices are rising or declining. Now, the reading has an excellent example about inflation and deflation, actually just inflation. And so what we've done is we've kind of replicated that example. So this is probably a super important one to know about how to manage if we are given exact rates of inflation in the question stem. Remember back here, and I'm going to scroll all the way back here, we were just given a table, and from that table we could infer that, well, we bought our first ones at around 50 and we bought our last ones at around 62. So those are rising prices, but we're not given actual rates of inflation for the inputs or over on the right-hand column for sales. But the reading has a terrific example, and we have replicated that here. So you ready for this? So we have two companies, A and B, identical in all respects, except A uses LIFO and B uses FIFO. Let's see, company's been in operation for 3 years, base inventory of 1,200 units per year. And so notice in that second paragraph, this is important. The number of units purchased is equal to the number of units sold. And of course, that's to make life super simple. for our understanding of the impact of inflation and deflation. And so if this exam question shows up, then I would guess that there would be a sentence in there that sounds just like what we have written here, because that's the way it works in the reading. Let's see, over a 3-year period, unit sales have increased by 8%, and inflation is 3% per year. So we sell 10,000 during that first year, $12 per unit, and the unit purchase price was $8. So let's go ahead and look at that LOS, explain how inflation and deflation affect all different sorts of stuff on the financial statement and in a handful of relevant ratios. All right, so ending inventory under LIFO is going to be an easy calculation, because this will be unchanged for every year, because we're going to have 1,200 units remaining in inventory. So those last in, first out are the ones sold. So the initial ones that we bought at $8, that's going to be 9,600 there. So that's a simple calculation for Company A under LIFO. A little bit more complex for Company B under FIFO, because we need to consider the rate of inflation only on the input side. So we sell the 12,000 times 8, 9,600 in the first year, right? In year 2, we sell the 12,000 at the $8, but that thing increases by 3%, so we get to 98.88, and then in the second year, we raise it to the second power to get 10,185. And by the way, if I were crafting CFA Institute exams, what I would love to do, and I think I say this regularly enough, I love to combine different study sessions and different readings. So this is a great way to ask a time value of money question embedded in an inventory valuation question. Now, sales under both LIFO and FIFO, this is not going to have any impact. I've said that multiple times, so let's go ahead and say something like, okay, what we're doing is we're selling the 10,000 at the $12 every year. $12 during that first year, and then we sell 8% more, so we need to multiply by 1.08, and then the rate of inflation is 3%, so we need to multiply that by 1.03. So that gets us up to the 133 and the 148, and of course this is identical for both companies. Now this is where it gets interesting, trying to figure out what those cost of sales might be. So what are we doing for year 1? Under LIFO, that's just the 10,000 times the $8. But in year 2, we're going to take that 10,000 times the $8 times the 1 plus the change in the 8%, and the 1 plus the 3%. And so we do that, raise it to the 1 power in year 2, raise it to the 2 power in year 3, and we get 88,992 and 98,995. So that 80,000 for year 1 under FIFO and LIFO is identical. But then what we need to do is we need to bring back that formula for years 2 and 3. Cost of sales is going to be our beginning inventory plus our purchases minus our ending inventory. And so that's what we've done for you down there. And this is really just a time value of money application. So in year 2, we have the 1,200 times the 8 plus the 10,000 times the 8, and then we're compounding that out, and then we need to subtract out that ending inventory, which only reflects that 3% input price, so we get 88,704, which is less than under LIFO, and then the 98,698 for year 3, which of course is less than under FIFO. So we need to be aware of what's happening here. Notice that our cost of goods sold, depending on which method we choose, LIFO or FIFO, under both scenarios, they are rising because we have rising prices, but they're rising at different rates. And so the rising at the different rates is going to be important when we get to a couple of different concepts here in a slide or two. I'll tell you about those here in just a second. But let's look at the last part of this LOS. So we've calculated and explained the effects of inflation and deflation on inventory costs. Now let's go ahead and look at the financial statements and the ratios. So notice what we've done. We've bolded in red in year 2 and 3 the differences between LIFO and FIFO, and then the impact on the financial ratios. Now, we're going to spend the very last slide or two computing these two ratios, the inventory turnover and the gross profit margin. So what I'm going to do is I'm going to say, hey, just take our word for it right now that those are correct ratios, but I'm going to ask you, once I show you those equations, I'm going to ask you to swing back here and do this on your own to verify that those are correct and that you can, what does that LOS say? Calculate those ratios. And I'll give you a little bit of advice once we get to those. Now, remember what I was saying just a minute ago, that those valuation methods, LIFO and FIFO, are going to result in different numbers that show up on the income statement. So what happens over time is that we might get this thing called a LIFO reserve. All right. So notice what we have in bold. This LIFO reserve is really just the FIFO inventory value less the LIFO inventory value. And so what happens over time when prices are rising, we're going to have a different amount. So let me read this here. It is the difference between the reported LIFO inventory carrying amount and the inventory carrying amount that would have been reported if the FIFO method had been used. All right, so let's look at the two bullet points at the bottom. During periods of rising inventory unit costs, the inventory carrying amounts under FIFO method will exceed the inventory carrying amounts under the LIFO method. And then when the number of inventory units manufactured or purchased exceeds the number of units sold, the LIFO reserve is probably going to increase due to the addition of those new layers. So imagine Anheuser-Busch, throwing a bunch of cases of beer on top of the line of those 10 during the course of my father's purchase of cases of beer. Now, sometimes the situation can be experienced when firms using LIFO, when the number of units sold exceeds the number of units purchased. Now, what I want you to do is I want you to look at the orange arrow point and notice that the second bullet point there says something like, this is a one-time event and is unsustainable. And the reading does a very good job of convincing us that this is a one-time event. And so it uses the clear example of a strike for the workers during the manufacturing process. So what happens during a strike? Of course, there are no units being purchased during that time, no units being manufactured during that time, and it's probably not sustainable. So there might be this event where we have a LIFO liquidation. Now look at the bottom arrow point there. This is probably a really good exam question. This liquidation may also generate a positive cash flow and result in higher taxable income. Now look in the very middle there. There's a super simple formula. So inventory under FIFO is going to be the reported inventory under LIFO plus that LIFO reserve. And you'll see that here just in a second with an example that we have come up with. What we're going to find is this LIFO reserve has to be reported somewhere as some kind of a disclosure and probably in a footnote. And so what this is going to do is tell us, as good financial analysts, the difference between the value of inventory between these two methods. Because, let's go ahead and face it. Suppose we're comparing two firms and one firm has an inventory of 100 and the other firm has an inventory of 50. Well, we may look and say, well, this one firm might be over inventoried. The other one might be under inventoried. And so we're trying to compare those two. But the LIFO reserve is going to equate those two inventory valuation methods. And so it might be that 100 is equal to 100 after we make the adjustments, or 60 is equal to 60 after we make those adjustments, depending on which direction that we're going. Now let's go ahead and decide what happens if we do this kind of a conversion. So what happens when a company says, you know what, we're tired of that old method. Let's go ahead and do the new method. So look at that teardrop point. Companies may change their inventory valuation methods. Of course, the international and the U.S. standards group, they don't force us to pick an inventory valuation method, but they say, you know what, when you pick one, you're probably better off if you stay with that for the rest of your lives. However, we're not going to force you to stay with it. So let's go ahead and, if you want to, make a change. But under the international standards, if the reason is acceptable, you know, like an acceptable reason might be to better reflect the value of our inventory, and that's an accounting theory kind of a question, then it is applied retrospectively. So we go ahead and restate all of our financial statements. But under the U.S. standards, switching from LIFO to another method requires that retrospective restatement. But if switching to LIFO, then it is done on a forward-looking or a prospective basis. So look at that last teardrop point. This is what we're doing as good financial analysts. We're going to evaluate the reason for switching the inventory valuation methods. While some reasons may be genuine, some may be there to reduce income tax or to increase reported profits. And that's okay, right? It's okay to try to reduce tax expense, but then we need to make certain that the auditors and everyone's doing their job properly, that we're paying our fair share of taxes and what is legally required. All right, a handful of points that we have based some of our discussion on, and some new points here. So what happens when our inventory becomes less worth? In other words, let's suppose that somehow that the inventory becomes less valuable over time. Maybe it's because there's a change in demand. Maybe there's a shift in the supply curve. Remember all that stuff that we talked about in our economics readings. Well, what happens then is that the two groups say something like, look, we understand that you think that your inventory is valued at this amount. However, suppose that because of some of these reasons that you won't be able to sell it for what it's worth, or maybe you won't be able to sell it for what you thought you could sell it. So this brings in this concept of writing down the value of our inventory. So how do we write this down? How do we reduce the value of the inventory? So under the international standards, the inventory can be carried on the balance sheet at the lower of the cost and the net realizable value. And net realizable value means something like, okay, all of the costs associated with getting the product to its final resting point so that it's on the shelf and my dad can pick up his case of Budweiser. Now, suppose for some crazy reason that Anheuser-Busch has this case of beer and it costs them $5 and they put it on a truck and they send it to my dad's beer distributor. But for some reason, the cost of fuel has gone up dramatically. And so that cost of transporting the case of beer from Anheuser-Busch to the beer distributor doubles or triples or quintuples. So, oh man, we have to add that net realizable value. So we need to make sure that we assign it the lower of cost or the net realizable value. And so you can do this either item by item or you can do it in groups. Now, when that is written down, then of course it shows up on an expense over on the income statement. Look at that fourth point there. Assessment of net realizable value should be made in each subsequent period. And then what happens if this is reversed? So we can have a reversal of this. And so this has implications for both balance sheet and income statement items. Now, the U.S. standards, however, say something like, look, you can do this at the lower of the cost or market value under the LIFO method, but if you do it under any of the other methods, then it is similar to what the international standards require. In fact, the reading goes to great lengths to say something like, hey, remember when we talked about in one of the first readings in this study session about the idea of convergence, that the US standards and the international standards, they ought to converge to make life simple for, not just accountants and financial analysts, but, shareholders and investors throughout the world. Well, the reading suggests that with the exception of LIFO, there is convergence. In fact, the reading has a sentence in there that says something like, for all intents and purposes, the U.S. standards and the international standards are virtually identical or virtually similar. I'm paraphrasing. It says something like that. Now, under LIFO, there is a current replacement cost in which they say something like, look, you don't have to pick an exact number like at 4 o'clock on this particular day, but you can have an upper and a lower limit. Now, U.S. GAAP also prohibits the reversal of those write-downs. So once in U.S., if that inventory is written down, then it cannot be reversed. Market values cannot exceed net realizable value. So that might be applicable to my example of the doubling or the tripling of those costs. All right, a couple of other things about write-downs and net realizable values. Just go ahead and skip down to the bottom two areas. Activity ratios, such as the turnover ratios, they'll be positively affected. And this is because this asset base, right, the inventories are probably going to be lower, and that's going to be against a higher cost of sales. So activity ratios are probably going to be improved. Net profit margin and other kinds of margins will probably be lower. Here's a good summary of what is required for disclosures for both U.S. and the international standards. So what do you have to disclose? Which method you use, right? LIFO or FIFO, total carrying amount, amount of inventories, amount of write-downs, amount of reversals, et cetera, et cetera. Now, what else should be disclosed? And this is where the reading kind of shifts from let's go ahead and think like accountants to let's think like what we're being trained to do. Let's go ahead and think and be good financial analysts. So what does this do for the impact on financial ratios? How about adjustments to inventory and the differences between those inventory valuation methods? And so notice at the top, choice of inventory valuation methods, and I'm going to put my own editorialization here, may have significant impact on the presentation of financial statements. Let's go back to my dad's first example. If every one of those cases of beer cost Anheuser-Busch $5 to put together, then it doesn't really matter whether we choose weighted average, LIFO, or FIFO. They're going to be, if not identical, virtually identical, and all of these adjustments that we had to make for the LIFO reserve and potential LIFO liquidation, we won't have to worry about that because, if prices go like this, then it doesn't matter what method that we choose. However, we know that prices go like that. They don't ever stay the same. Now let's go ahead and make a distinction between what happens at the Anheuser-Busch manufacturing facility during production, right? We're taking, let's just be barbarians here. Let's grab a handful of yeast and throw it in the pan, grab a handful of barley and throw it in. Well, that's probably not a finished good. And so both the international and the U.S. standards require a distinction between finished goods and work in process or work in progress. Oh, let me say one other thing here. Of course, you can look in the disclosures, but you can also look in the analysis and the discussion from the managers. And I've always said that, if I ever became a really good writer, I would love to edit some of these MD&As because they can be dull. and I would put some fancy language in there so that it would bring management discussion and analysis to life. Like, oh man, when we wrote down that inventory, man, we really struggled. Should we do this or should we not do this? And then in the end, I would love to write things that say something like, we did what we felt was going to maximize shareholder wealth. After all, that's what we're hired to do as financial executives, to be good stewards of the bondholders and the shareholders' capital. All right, let's go ahead and end with an analysis of some financial statements and some financial ratios. So here we are, we're doing LIFO for 2021. So on the left-hand column, we have an income statement. Right-hand column, we have a balance sheet. Under the notes, we observe a LIFO reserve of $2,500 this year, 2021, and $3,400 in 2020. So that's a change of, what is that, $900 in a change in the LIFO reserve. So what we're trying to do is say something like, all right, here's ABC, it uses LIFO. We're comparing it to some company over here, right, XYZ, and this company uses FIFO. We want to compare those two. In order to do that, we need to say something like, okay, what would ABC look like if it used the FIFO method? So there's some calculations for cost of goods sold. So under FIFO, we get $375,900. Total inventories would be $20,500, and then net income would be $335,280. And so note in that bottom left-hand adjustment, we also need to have a reduction in our taxes because we're going to have a lower operating profit had we used that FIFO method. So don't forget to throw in that 180. Now, of course, we probably don't have enough information to compute that here, although we could go ahead and do 20% of that difference. 2 times 9 is 180. 2 times 9 is 18, so that gives you the 180. And so go back to here. If you're given a question like this on the exam, you may or may not be given that 20%. So look for that 180, either to be given or to calculate it on the exam. So here's what I was saying earlier. Notice around the table, we have put together a whole slew of financial ratios. So you probably ought to get your phone out, take a picture of those. Although you may have been able to memorize those at this point in your level 1 studies. But go ahead and compute those ratios under LIFO and then under FIFO, and clearly you can address this LOS that says something like, boy, compare financial statements and ratios under LIFO and FIFO. So you can envision a question that might say, and here I'll just skip to the bottom one. What happens to liquidity when the firm selects LIFO versus FIFO? So you can say something like, oh, under LIFO it was 229 current ratio, under FIFO it was 234. And I'm going to go ahead and scratch my head and say, in this example, as a good financial analyst, I'm not going to attach almost zero significance to that change in the current ratio because those are super similar. However, I'm guessing on the CFA exam they would arrange these inputs so that the current ratio under LIFO might be, let's say 1.29, and under FIFO it might be 1.79, and then you have a substantial difference, and then we need to do our good work as good financial analysts to make a conclusion about, okay, which method, and then let's go ahead and compare that to this XYZ company that we have over there. So feel free to take a picture of this and then swing back to that earlier slide where we had all the financial statements and then a couple of those ratios down there. And that takes us through the LOSs. Clearly LOS number 2 there describe different inventory valuation methods is the most important, followed very closely by the calculate, the third one, all the stuff that we have been doing. Now I'm going to end here by giving you some advice, and you're not going to like this advice. I'm going to say go back to the reading. The reading has a handful of really, really good practice problems. In addition, it has 55 or 58 end of reading practice problems. So go ahead and work on those in the reading. Work on the 55 at the end of the reading, and then go to our practice questions. If you do all those questions, man, you're going to be all over this material. And then, and only then, go to, I've said this to you guys before, go to the mock exams. I know some candidates like to just go to the mock exams right at the end to say something like, oh, I want to know how I'm doing. But I would do it the other way. I would save the mock exams for the end. Anyway, thank you for watching, and good luck studying.